The money in your bank account doesn't really sit there. That's not a metaphor, and it's not conspiracy talk. If every customer walked into their bank tomorrow and demanded cash, the system would seize up in hours because the physical cash simply isn't there. That isn't a glitch, it's the blueprint. It's called fractional banking, and it's the quiet engine behind global credit, inflation pressure, and the modern illusion of effortless wealth. Once you see how it works, you realize money today is built on promises that can't all be kept at the same time. Before digits lived in apps, gold and silver were money. If you were wealthy, you held coins in a chest or jewelry you could trade. But carrying treasure was dangerous. So people began leaving valuables with goldsmiths' men who had vaults. The goldsmith issued a receipt, a claim ticket saying, "Bring this back and you'll get your gold." Pretty soon, people noticed those claim tickets were easier to pass around than metal. They began to circulate. A paper promise started to function like money. Here's where the trick began. Goldsmiths realized withdrawals were staggered. Of 100 clients, only a few showed up on any given day. Most of the gold sat still. So the goldsmiths issued more receipts than gold on hand and lent those extra receipts at interest. If they had 1,000 coins, they might issue 2,000 in notes. As long as everyone didn't demand coins at once, the scheme held. Money creation had just slipped the leash of metal. Banks institutionalized the practice. By the 17th century, governments embraced it. 1694, the Bank of England is founded to finance a crown drowning in war debts. The bank lends more than it holds, and the public repays through taxes with interest. Sound familiar? That basic loop remains. Borrow now, tax later. Early American banks followed the script. They issued banknotes, redeemable in gold, then issued more. Periodic bank runs exposed the gap crowds demanded redemption. Vaults came up short, and banks failed overnight. Instead of abolishing the model, governments doubled down. They created central banks to backstop the system lenders of last resort to keep confidence alive. The message was clear. Even if the cash isn't there, the belief must be. Now, fast forward to how it works today, because the old textbook story about a 10% reserve ratio barely describes the modern machine. Imagine you deposit $100. You picture it waiting in a drawer with your name on it. Historically, a bank kept a slice, say 10%, and lent the rest. But in the U.S., since March 2020, reserve requirements on many deposits were set to 0%. That doesn't mean banks hold no reserves at all. They still need reserves for payments and clearing. But it does mean the formal reserve ratio no longer constrains lending the way the textbook suggests. So, what does? Today, the leash is capital and liquidity rules set under the Global Basel framework at the Bank for International Settlements in Basel, Switzerland. Banks must prove they have enough equity capital to absorb losses and enough liquid assets like cash and high-quality government bonds to survive stress. In simple terms, the riskier the loans, the more true equity they must park behind them, and the more liquidity they must carry to handle a run. Here's the crucial shift most people miss. Banks don't lend out your deposits in a mechanical way. They create deposits when they lend. When you get a mortgage, the bank doesn't pull cash from a vault. It types a new deposit into your account. That new money exists because you agreed to owe it back. Only afterward does the bank make sure it meets capital and liquidity rules. That's why, in most advanced economies, the majority of the money supply isn't paper cash or central bank reserves. It's commercial bank money, created the moment loans are booked. That architecture drives three systemic outcomes. First, inflation pressure. As banks expand credit, more claims chase the same goods. Prices don't rise only from supply shocks or demand. They rise because the unit of account is being multiplied through credit. Second, perpetual debt. Money enters as a loan. Interest ensures there's always more owed than base money outstanding. System-wide, someone must refinance, roll over, or default. The balance sheet never truly closes. Third, concentration of power. Banks collect interest on money they create with keystrokes. Governments tap the same mechanism to finance wars, programs, and rescues without raising visible taxes immediately. Asset owners benefit as credit inflates asset prices. Wage earners watch purchasing power thin. When confidence wobbles, the illusion shows. In 1929, credit outran collateral, runs and failures cascaded. In 2008, mortgage credit was sliced, rated, and sold until defaults snapped the chain. Liquidity vanished, funding froze, and balance sheets imploded. Each time, policymakers didn't unwind the trick, they scaled it. Emergency guarantees, balance sheet expansions, near zero rates. Why? Because without credit money, the modern economy stalls. And this isn't just an American story. The knobs differ, but the machine is global. The US, UK, Eurozone, Canada, Australia largely rely on Basel capital and liquidity rather than binding reserve ratios. Many emerging markets, China, India, Brazil, and others, still use reserve requirements as an active policy lever, often in the double digits. But even there, Basel rules sit on top, shaping how much risk a bank can take and how much loss-absorbing capital it needs. Wherever you live, the constraint on money creation isn't a pile of deposits in a vault. It's regulations and confidence. Here's the uncomfortable part. The system can't afford everyone to be debt-free at once. If households and firms paid off every loan tomorrow, broad money would shrink violently. Bank assets, loans would vanish, funding would contract, new lending would stall. The economy would convulse. The machine needs a flow of new credit just to keep the treadmill moving at the same speed. If this sounds like a centuries-old magic trick scaled to planetary size, that's because it is. Medieval goldsmiths discovered the spread between promises and metal. 19th century panics showed how fast confidence can evaporate. The Great Depression and global financial crisis showed how suddenly credit money can vanish when collateral sours and trust breaks. Each shock produced the same response. Patch confidence, widen the safety net, expand central bank support, and carry on. So what should you take away? Money is not wealth. Digits are claims on wealth, not wealth itself. Real wealth is the stuff that holds value when credit contracts, productive assets, scarce resources, skills, knowledge, resilient cash flow things that exist outside a spreadsheet. Debt isn't neutral. It is the bloodstream of a design that structurally favors lenders, states, and asset owners over pure wage income. Use debt like a tool for cash-flowing assets or capability building, or it will use you. Inflation isn't purely an accident. It's often the byproduct, and sometimes the policy, of a system that grows by expanding claims. You're asked to run faster each year to stay in the same place. Does this mean doom is inevitable? No. It means your strategy must adjust to the machine you live in. A bank balance by itself won't insulate you from a monetary regime that thrives on dilution. Understanding how money is made and who benefits lets you build buffers outside the cycle, diversified income streams, productive skills, assets that throw off cash, and room for error. One more thing about the money isn't there. In a narrow sense, yes, banks keep only a fraction of deposits in cash and reserves. But the modern backstop is institutional, deposit insurance, central bank liquidity, lender of last resort facilities, and resolution regimes. The goal is to prevent a classic run from turning into a systemic collapse. That doesn't abolish risk, it reassigns it to taxpayers, to future inflation, to sovereign balance sheets. The bill always lands somewhere. Every crisis you remember is, at root, a confidence story. The foundation isn't gold bars or perfect productivity. It's the shared belief that tomorrow's payments will clear. And belief is fragile. When it cracks, money evaporates faster than it was created. So, the next time you glance at your bank balance, remember, most of it is an IOU typed into existence when someone borrowed. Know the trick, and you can protect yourself from it. Ignore it, and you remain a piece on a board the house designed to win. If this sharpened your lens, subscribe. History doesn't just explain the past, it helps you survive the future.